Okay, so we're going to do some practice problems here based on the two lectures that we did already on trade. And so these two lectures were about the current account and the financial account, and then thinking about how do we model the financial account with the loanable funds market, and then some basic ideas about barriers and free trade. So let's go ahead and get started. In the first set, we're asking from the US perspective, is a transaction an inflow or an outflow? And then where does it get counted? Now, I understand that actually, because it's a balance, we sometimes I have students who'd say, well, it counts on both because it counts as an inflow on one and an outflow on the other. No, that's not correct. So each transaction only counts once, but it's going to be balanced by a transaction on the other account. So let's take a look at that with some of these practice problems. An American student studies and pays tuition at a university in Australia. So from a US perspective, is the money flowing in or is the money flowing out from the United States? Well, hopefully you can piece together from this that because they're paying tuition to an Australian university, this is money flowing out. So it's an outflow. And the money is flowing out in exchange for a good or a service. In this case, this is a service. And so we would say it's the current account. Now, students who would say, well, but Mr. Glossinger, it's an inflow on the financial account. Well, no, this exact transaction is not, but it's balanced by some other transaction that would be an inflow. So the Australians have to do something with that money. And when the Australians, maybe the Australian government or whoever gets the money from this tuition, what do they decide to do with it? Maybe it's the Australian university says, let's put those dollars into the US stock market. That would be a separate transaction, and that would be an inflow from the United States' perspective because the money's flowing back to the United States and it's on the financial account. But this transaction, the American student, is not on the financial account because it's not an exchange of a financial asset. Number two, a German telecommunications company buys microprocessors from an American company. So in this case, again, we're thinking about it from an American perspective. So the American company is receiving the money, right? That's what the important part is inflow and outflow is about the money. So the money is flowing into the United States, and we would say because it's a good or a service, it's the current account. So the current account, just as a quick review, the current account versus the financial account, since it's not right in front of us, is net exports and income, and the financial account is stocks, bonds, and real estate. So it's those things, right? Net exports, income, stocks, bonds, and real estate. And this is really just financial assets is another way to think about this. These are just financial assets that are on this side. So now let's take a look. Number three, an American bank buys Japanese stocks on the Tokyo stock market. Well, there we go, stocks. So this one has to be the financial account. But now let's ask ourselves, is the money flowing into the United States or out from it? Well, the bank is buying Japanese stocks, so the money is flowing out from the United States. Number four, an American doctor sends money to her family in Ghana every month. So from the United States' perspective, this money is flowing out. The money is flowing to Ghana. But I know this is a little strange, but income includes what we call transfers. And so this is going to be counted on the current account. It's not a payment for stocks, bonds, and real estate, but it's more like income for her family in Ghana. The American company Walmart earns profit from its stores in Europe. So this is an American company getting money, so the money is flowing in. And when we say it's income, that's wages, rent, interest, and profit. And so this is income, so it's the current account. Number six, the US exports and sells cars to Canada. This is again a net export, so it's the current account, and the money is flowing into the United States. A Brazilian company buys an apartment building in Boston. That's real estate, so this is going to be the financial account. And on this one, is the money flowing into the United States or is it flowing out from the United States? Well, the Brazilians are buying the building, so they're giving money to the United States. So we'd say it's an inflow to the United States. The Central Bank of China buys a US Treasury bond. So this is a bond, so it's the financial account. And again, is the money flowing into the United States or out? Well, the money is flowing into the United States because they're buying the bond. That means the Chinese are supplying the money into the United States. The US imports oil from Venezuela. So if we're buying oil from another country, that means we're giving them money. So the money is flowing out. And is this a stock, a bond, or real estate? No, it's net exports. So we'd say it's a current account. An American company, Pepsi, buys land and a factory in Mexico. So is the money flowing into the United States or out? Well, no, it's flowing out because it's going into Mexico. And from our looking at it here, stocks, bonds, and real estate is land and a factory, so that would be the financial account. An American businessman has paid dividends from a French company, so this would be profit. It's corporate profits, and it's flowing into the United States on the current account. And Belgian InBev company buys an American company, Anheuser-Busch. So this would be the money flowing into the United States, and it's on the financial account because they're buying stocks. Okay, now we're going to take a look at the loanable funds graphs for the US and France and show the shift of financial capital between the two countries. We're actually going to start with the real interest rate in France being 5 and the real rate in the United States being 2. So we have to draw two graphs, and both of these are going to be kind of rough here. QLF, and we'll put France here and the US here and the real interest rates. So it says that in the France, the rate is 5. Boy, this is going to be rough. I'm sorry. And then in the United States, the rate is 2. So the rate is 2. So the money will flow from the United States over to France because the Americans are going to want to put their money into a higher interest rate, right? The Americans are going to say, oh, I'd rather have a higher interest rate. The effect of that is to increase the supply of loanable funds in France, and it pushes down the interest rate in France. Now, it's not going to go all the way down from 5 to 2 in France. It's going to meet somewhere in the middle, maybe 3 or 4 or something like that. It will equilibrate between the two. But here's the question. Which country will now have a higher rate of investment in physical capital? Well, which country is actually getting a higher interest rate? Well, the higher interest rate is going to be the US. The lower interest rate is France. And so this one, that lower interest rate, think about it like this. Interest rate in France goes down. So therefore, investment spending in France goes up. So we'd say that France has more investment in physical capital because France is going to have the lower interest rate. Now let's take a look at the last problem in this practice problem set. Suppose Mexico cuts its tariffs on imported automobiles. How would the decrease in taxes affect each of the following in Mexico? Mexican consumers. Well, if Mexico cuts its taxes on imported automobiles, the cars that are coming in are going to be cheaper for Mexican consumers. So it's going to, and then this is silly. This says harm hurt, so I should probably fix that. Why don't we say help hurt? I clearly made a mistake here. And help. So I gotta fix that. But it's going to help the Mexican consumers because now the cars are cheaper. What about the Mexican automobile manufacturers? Well, the Mexican car manufacturers are going to be hurt. And they're going to be hurt because they're going to have more competition from imported cars. What about Mexico's financial account balance? So this one is a little bit harder to think about, but think about it like this. If this happens, right? If that happens, then the Mexican XN will go down because they're importing, there's more imports. So this is how we're going to think through this. If they cut the tariff on imported cars, the imports will rise, so net exports will go down, Mexican net exports. If that's true, that's the same thing as saying the Mexican current account is going negative. And if that's true, that's the same thing as the Mexican financial account going positive. And which of these here, the financial account balance is going to surplus. So it's a logic chain that we have to kind of think through on that part. Now, given the change in Mexico's current account, what's going to happen to aggregate demand? This is actually kind of an easier problem because we've already said here Mexican net exports went down because they're importing more, so therefore their aggregate demand is going to decrease. Assume instead of the change in tariffs, there's an increase in real income in Mexico. So in other words, ignore all that stuff. How would this affect the Mexican current account balance? Explain. This one's a little bit hard to understand as well, but think about it like this. If they have more income, if Mexican people have more income, then they're going to buy more. So income increase, therefore they buy more. And if that's true, they're buying more of everything. So therefore we would say they're going to import. Boy, that's terrible. Let me erase that. What's going to happen to their imports if they're buying more? Well, that means their imports go up. And if their imports go up, that means their current account is going to go negative. So just because their income is rising doesn't mean they're going to sell more to other countries, but it does mean they're going to buy more from other countries. And some portion of their buying is going to be imports, so their current account will go more negative. So hopefully this practice problem helped you understand a little bit more of the ideas behind current account and financial account and inflows and outflows. And I will